House prices to boom by 16%. Let's have a look. Hello everyone, Florian.Heise here and welcome to another episode of HeiseSays. Grab your stein of coffee. Let's look at this article from savings.com.au written by Alex Brewster. So, Combank, house prices to boom by 16% in 2 years. Fantastic. Remember when the CBA was saying we'd have 30% falls? Remember that? I do. I'm referring to it again and again. We had Kukulis telling us to cool down a little bit, this potential boom. But then we're seeing stuff like this. Is this FOMO? Is this design? Fear of missing out? Will it cause people to make irrational buying decisions? Do people just jump into the market no matter what? I'm concerned for the long-term viability of our civilization if we continue to just focus on housing. It's not going to lead to any complexity, is it? We're not very innovative, are we? Do they still call us the innovation nation, or is that tagline fallen away? Maybe I'm not watching enough government propaganda. Let me know for those of you that watch the mainstream channels. So, CBA forecasts dwelling prices will rise 8% in 2021, the year after our first recession in 28 years, mind you, and 6% in 2022, with house prices to rise 16% in that time and unit prices by 9%, evidencing the disparity in the sectors. Oh, unit prices are going to go up by 9%, where migration's down the toilet, where international students may never come back. Sure. Where everyone is flooding to the regions to get out of the cities now because our way of working has changed. Where JobKeeper is coming to an end. Where people have already pulled out their super. But wait, now it'll probably be, well, maybe we'll super fuel this. Will that be what it is? Oh, the super funds wouldn't like that. You can't have your plebs owning their own house. You know, they need to be dependent on you. And then you can tell them how they can spend their own money. That's what you want. CBA head of Australian Economics, Gareth Arad, said surging momentum in the property markets and leading indicators pointed to strong price rises. New lending has lifted sharply. Or lending indicators. New lending has lifted sharply. Dwelling prices are rising briskly in most capital cities except Melbourne. Turnover is up significantly on year-ago levels, Mr. Arad said. Near-term indicators of momentum suggest conditions will further strengthen. Auction clearance rates are sitting at levels consistent with double-digit dwelling price growth. Now, auction clearance rates, it's just trend. It's not 100% accurate. But they don't care about that, guys. There should be a little asterisk next to that. But then again, this is journalism too. It's not the same as an academic piece. I remember when I was writing my thesis, we were told never to even refer to media work or newspaper clippings. So, both the CBA home buying measure in our household spending intention series and the house price expectation index from WBCMI Consumer Sentiment Survey have surged. Darwin is forecast to be the strongest capital performer, with values rising 12% this year and 6% next year, followed by Perth and Brisbane. Sydney and Melbourne are the laggards, rising only 7.5% and 7%. Remember, this is when they're saying we have CPI at 0.9 and 5.8 and 5% next year. You know, you're looking at dividend shares, maybe 4 to 5% if you find some companies that are making money. Look at this. Why would anyone start a business? You know, even if it's just FOMO, but if it's enough, is it the ultimate Ponzi scheme here in Australia? You know, forget Dogecoin, forget bloody Bitcoin. You pump out the housing. We've been doing it for decades. Musk has a lot to learn. You know, he needs to talk to our politicians. CBA's house price forecasts underpinned by no change in the cash rate for the next 2 years, with the RBA stating the rate was unlikely to be changed for 3 years. Fixed rates have dipped below 2% for the first time ever in recent months, with many lenders offering such products, but CBA said this may be a temporary trend. We do, however, factor in a modest increase in fixed-rate mortgages, which will rise if the RBA removes or raises its target yield on the 3-year Australian government bond, as we expect in the second half of 2021, he said. The main risks to the forecast boom were a significant outbreak of the pandemic, followed by large-scale lockdowns, a hike in interest rates, and reintroduction of macroprudential measures to slow the rate of lending. At this stage, we consider the reintroduction of macroprudential measures to be relatively low risk in 2021. However, if new lending accelerated too quickly, particularly to investors, there is a risk that the Australian Prudential Regulatory Authority could reintroduce measures to slow things as they did in 2017. History shows that prices can rise very quickly when the housing market is on a roll. Indeed, it may turn out to be the case that the growth profile for price outcomes over the next 2 years ends up more front-loaded than our current projections. So central bank needs a reset. Strange use of the term, isn't it? Mr. Arad said, with the cash rate at its effective lower bound, it would be incredibly hard for the Reserve Bank to raise the rates given the level of household indebtedness. This means that when the next negative economic shock arrives, we're unlikely to have the interest rate lever available to give households debt relief. Oh, yes, we do. We'll go negative, just like they have in Europe. Won't work, but they'll do it. They'll do it. They won't reset. In addition, we won't be able to stimulate the interest rate sensitive parts of the economy with more rate cuts. They'll just print more money. Mr. Arad said the cash rate was all out of rope as a monetary policy tool, leading CBA to believe the central bank may need some sort of reset. This leads us to believe that we may be inching towards a new paradigm that will involve some form of monetary financing in the future, i.e. a direct transfer of money from the central bank for government to spend. Oh boy. Oh boy. What do you think that's going to end up as? Oh. It may still be a long way away, but the bottom line is that the system as we know it will need to be reset, and the printing press will need to be part of that reset. Are we looking at a currency reset? This is the first we've heard mention of this in any article or reporting that I've found. Very interesting. What do you reckon? You think it'll be crypto backed? I think it'll be central bank digital currencies with supreme control for the central banks down to the individual unit. I don't think it'll be any of the cryptos that already exist out there. I don't think it'll be a gold-backed currency or a silver-backed currency. I hope it would be something, a Bitcoin-backed or a precious metals-backed, something solid. No. It's going to be a central bank digital currency where they can control you down to the unit of your spending. They'll link it up to the GPS on your phone. They'll track your social credit score with your posts. Oh, sorry, you've watched too much HeiseSays. Oh, we're going to have to ding you there. Uh-oh. Remember, housing always goes up. You need to say it 50 times onto your social media posts, then you'll get your spending back. I'm being facetious. Or am I? What do you reckon? Maybe I just need more coffee today. Anyway, guys, thanks for watching. Please like, share, and subscribe to the channel. If you're a fan and enjoy the content I create here, there are a few ways you can support us. You can join the channel on YouTube or Patreon. You can support us using our affiliate links from Amazon, eBay, Independent Reserve, or AussieBroadband. You can buy merch from HeiseSays, use a Gold Pass from the Perth Mint, or support us via PayPal. You can also join MeetRx or SelfWealth to support us that way. Take care. I'll see you all in the next episode. Bye for now.